Thank you very much. First, I did want to make sure that everyone can hear me. I know that I hate to have you do this again, but if we could do just a simple sound check, I guess people can hear me then, huh? First of all, thank you very much, and really welcome, and thanks for sharing a half hour to an hour with me. In the short time that we have together, I want to give you a little bit of background about how I came up with the techniques that I use, what events really showed me and gave me insight into technical analysis and allowed me to really continue an adventure that started, I hate to say this, but pretty much 30 years. Because I began in 1983 as a standard commodity broker. I was basically what's called a green pea, and I quickly realized that the majority of the clients that traded commodities lost money. I hate to start by saying this, but the fact is that it is a shark infested pool, and to have success within the commodities markets or as a trader as a whole requires a pretty steep educational process and learning curve. I realized very, very quickly that I loved the industry, I loved trading, but that if I couldn't have an effective approach, meaning have my clients gain insight into the market and have them effectively be able to pull profits from the market, then I should be selling cars, or I should be selling coats, or I should be selling airplanes, but I certainly shouldn't be making recommendations for traders to trade with. And about 5 years into my education, and this is really about 87 or 1988, I started to do a very, very small television show on an unknown station in Southern California called Channel 22 or KY. For those, I'm 58 right now, but for those that remember, there was a time when we had UHF and VHF. This was a small UHF channel in Southern California. But I was able to meet the market analyst there, the person that did all of the chart works, and his name was John Bollinger. Many of you are probably familiar with John simply because he's the one that created Bollinger Bands. John was gracious enough to spend time with me and to work with me and to show me what insights he had into the market. And I came up with the conclusion that it was an abundance of Western technical indicators that were out there, and it wasn't so much the indicators themselves, it was the finesse or the way those indicators were used. In other words, stochastics, moving averages, Williams percent R, RSI, RMI. It was using them in a certain way that I found had some effectiveness. And during my tenure in the industry, I had a particular client. His name was David, and he was an engineer for General Electric, actually. And he started placing trades with me. At this point, I was a CTA, but I still took on basically traders that wanted to just trade, where I wouldn't advise them. And I started to notice that he had a win rate that was exceptionally above the basic bar. He was hitting about 8 to 9 out of every 10 trades he did. Oil would move up, and I'd get a call, and the call would say, sell oil. I go, David, the market's moving up. He says, just go ahead and please sell it. I go, okay, I'll place the order for you now. And sure enough, he was hitting tops and bottoms of the markets, and it was almost uncanny. And I remember speaking to him on the phone one day, and I basically said, David, are you using witchcraft? What is it that you're using that gives you this incredible success in the marketplace that I, quite frankly, haven't seen with any other trader? And I've been doing this for close to 10 years. He said, well, I use these funny little characters called candlesticks. And I said, well, what are candlesticks? He says, well, it's a way that the Japanese have been analyzing their markets since the 1600s and the onset of what's called the Dojima Rice Exchange. So I realized that as a Western technician, there was a counterpart. There was another facet that used similar techniques, but in a completely different way. And in fact, John Bollinger wrote the foreword to my first book, Trading Applications of Japanese Candlestick Charting. And in that foreword, he talks about the work I do being analogous to the old story of three blind men and an elephant. In other words, as market technicians, we were all looking at the same elephant. But one would grab the tail and he would have a certain sense of it. One would grab the trunk, he would have a certain sense of it. One would feel the hair on the tail and he would have a certain sense of it. And it was a point that the idea was to get a more holistic view of the marketplace. And I realized the first thing I really wanted to do was really understand Japanese candlesticks. With a simple yes or no, how many are familiar with the basics of Japanese candlesticks? Because if most are, I'm not going to spend a ton of typing or a ton of time with them. Little. Well, to give you a basic idea of how a candlestick actually works, really all it is that when you basically have a bar chart is going to show you an open, low, high, and close, and it's basically going to look like this. You're going to have a line, the bottom of the line representing the low, the top representing the high, and then there's just a simple line representing an open and close. So for example, you might have a scenario where the market opens at a certain point and then closes higher. And this is how it would be illustrated on a bar chart. I'm assuming everybody can see that. And if the market, for example, was to open at a certain point and then close lower, the bar chart's going to look like this. So this is a down day. Let's assume these are daily charts. This is a down day and this is an up day. And you can see that in terms of how they look, they're very, very similar. All the Japanese did was they created a rectangle between the open and the close. And the high of the day and the low of the day would be your wicks. And I realize it's not centered, so please excuse me. And the key is they would fill in the candle with a different color. So if it's a down day, for example, it might go in red, an up day might go in white. There's different color codings for that. But here's the beauty of a Japanese candlestick. Japanese candlesticks are able to express market sentiment mathematically. In other words, there are particular patterns found within candlesticks that really mathematically uncover or unfold market sentiment. And that to me was fascinating. And I'm going to go through a couple of different types of candlestick patterns throughout the presentation itself. But suffice it to say, I realized that there was some really, really quality information that could be obtained with candlesticks, but I had a basic difficulty. My client, David, had sent me a book by Seiko Shimuzi called The Japanese Chart of Charts. It was just translated into English about a year prior to that, and that was the first real piece of knowledge that came out of the East that let us understand what candlesticks were and how they were used. And as I read the book, it took me about 2 to 3 reads, really, before it started to click. I realized that not only do they use candlesticks, but they also use candlesticks in relation to where the market is, and they use moving averages fairly aggressively. And I realized that it was a combination of the indicators and the way that they used them that made this technique so unique. And I actually realized that it was very, very difficult to explain how these candlestick formations look. And myself and my partner at the time, Brad Matheny, actually came up with an idea, and we were the first in the United States to develop an automatic computer recognition system for Japanese candlesticks. And in fact, that's when I was first introduced to a data broadcast company, which is now Interactive Data, or eSignal, which then was Signal. In fact, their data has always been so clean and really good that it was data that I used. And this is back in the 90s. We copyrighted the program in 1991. And by 1993, I was really doing a lot of lecturing, and that's when I wrote my first book. Second book was in 1998. but I got a sense for the marketplace itself, and I realized that it was more than the techniques that were being used, but it was the combination of techniques that were being used. And the way that we came to that conclusion was we spent 6 months coding and developing all of the candlestick patterns that I was aware of. And yet, when we ran a system study on how accurate the candlesticks were, we found that they were not as accurate as myself or David making calls. And we realized the distinction or the difference was that we were actually filtering the candlestick patterns with other Western technicals and other observations within the marketplace itself. And that's what really made the system unique. And I worked with different Western technical indicators, stochastics, as I said, moving Williams percent arm, RMI, and I realized that there were a couple that kind of really fit together, and I began to study what's called Elliott wave theory. And in terms of Elliott wave theory, there's some people that swear by it and some people that think it's absolute quackery. My take on it is an art as well as a science. There's no doubt about that. It's not as straight cut of an empirical study, of course, as a moving averages. There's no gray areas in a moving average. It's above or below a moving average. But there is gray areas in Elliott wave. And within candlesticks, it's pretty hard coded. But what I realized is that if you combined Elliott wave, Fibonacci, and candlesticks, you had a very, very unique approach to the marketplace. Now, back in, and I'm going to bring this up, this article, I believe, came out in 2009. And this is where I first actually revealed and kind of illustrated the technique that I was about to develop. And basically what it entails is the fact that by combining the three techniques, Elliott wave, Fibonacci, and candlesticks, we were able to have market insight that, quite honestly, you could not gain with any of those components not combined. And to give you an idea, at that time, and it's hard to say, but when I began the gold forecast, I think that gold was trading at around $900 to $1,000. And it was almost a textbook case. Basically, in Elliott wave theory, the idea behind it is that markets move in a natural cycle, and that even investor psychology or sentiment has a pattern, and that pattern, if uncovered, will produce great insight into the market. In essence, his belief is as follows. He believes, Elliott wave, I should say, believes that, let me go ahead and change my color here, that in essence, a bullish market is comprised of a total of 8 waves. The first 5 waves are basically called your impulse phase. So you get wave 1, you get a corrective wave 2, you get wave 3, a corrective wave 4, and then that concludes at wave 5. Now, obviously, this is in its most simplistic format. Once you go wave 1, 2, 3, 4, and 5, you go into your corrective stage, which typically is composed of an A, a B, and a C. Now, there's defined rules, of course, as to where the wave 4 can go down to, and the fact that wave 3 cannot be the smallest of any of the 3 impulse waves. But in essence, what you get with this is you get a total of 1, 2, 3 impulse waves, and those impulse waves, of course, have corrective waves in between them. When you go into your basic counter waves, which is here, or your corrective waves, your first A wave is going to be down. Your B is a counter wave because it's counter to the trend. The trend at this moment here is going to be down, and then your final C wave. Now, this can unfold in many different ways, as you'll see, and we look at real-time market applications, but oddly enough, at that time, it was almost a textbook case in the way that the market traded. And for example, this particular ABC that we got, and you can see the market's trading at around 1200 here, and it falls to around 1050, this low right in here. It did come out to a perfect ABC which is your A, your B, and then your C. Now, once a C concludes, you go back into your impulse phase. In other words, if the fundamentals, if what actually drives the market are still intact, you'll repeat this cycle over and over again. Which brings me to what I think is a critical point that I actually haven't touched upon, and that is, as a market technician, I have to let you know that I'm a staunch believer in fundamentals. Fundamentals move the markets, not technicals. But what technicals do for me is they allow me to distill that fundamental information, which quite honestly confuses the heck out of me, and distill it into numbers which I can actually not only make an observation, but a correlation, and from correlation draw an assumption, and from assumption a trading strategy. But just to give you an idea of how precise this technique can be, your wave one is what's called your benchmark wave. And once you have your wave one in place, there is an entire strategy of how 2, 3, 4, and 5 will play out. One of the strategies is that wave 2 is typically your deepest wave in terms of how far it corrects or retraces. And typically it's a 61% correction. When R.N. Elliott actually came up with his wave theory, he was not familiar with Fibonacci, but as he looked at Fibonacci after developing the wave theory, he realized that they were really part and parcel of the same thing. And so this particular wave down actually came to exactly 61%, and that made it kind of unique. But what I found is that by just utilizing it alone, it wasn't giving me the information that I needed. And the reason is that I needed something to filter it with. And so this triple filtering system that I came up with was the direct result of the work that I had done. Let me go ahead and try to blow this up a little bit, because this is kind of an important model chart right here. I hope everyone can see that. Let me get my drawing tools up. And what I'm talking about is this. In a most simplistic manner, this is your basic rules that you have in Elliott Wave. And your basic rules in Elliott Wave are as follows. Your wave one, as I said, that's your benchmark wave. Now realize, if you think about Russian dolls, within this wave one, you're going to get a subcount of 1, 2, 3, 4, and 5. So you can always take each component and break it into its micro, into its micro, into its micro, and keep going deeper. However, once wave one is created, on a typical correction, you'll look for it to go to about 61%. And once again, 1, 2, 3, 4, 5, and then A, B, C down. So wave one contains 1 through 5, and wave two contains A, B, C. In other words, this particular phase right here can continually be broken down. You can then take this one here and go 1, 2, 3, 4, 5, A, B, C, 1, 2, 3, 4, 5, A, B, C. So it's kind of like Russian dolls. But as you can see, so on a benchmark textbook case, you'll get a rally, you'll get the market retracing, roughly 61%, and then from there you go to wave three. Now wave three is, by rule, cannot be the smallest of any of the impulse waves. And traditionally, you look for wave three to be about 1.618% of an extension from wave one. In other words, if this is a move from 0 to 100, and this starts, let's say, at 100, we make the correction, but this move would be from 100 to 261. In other words, you get a 1.61% times wave one. Wave four is typically, in terms of correction, less steep, and you can see it's 38% right here. Again, this is just the model. Again, A, B, C, and then wave five, as a textbook case, is usually equal to wave one, as you can see right in here. However, what I have noticed in gold is that it's wave three is not going to be your smallest, but it's usually a little bit bigger than one, but it's wave five, where the market really takes off. Now, this is your textbook case right on the left. On the right, you can see how this can be applied to real-time market scenario. So we get C, this is the conclusion. And by the way, this point in time, I remember this very, very much because this is when it was announced that George Soros was a huge buyer. And you had this unique candlestick pattern down here, which is a unique three-river evening bottom, and it's with a long-legged doji. If time permits, I'll cover that a little bit. But so you get your first wave one, that's going to be right here. And from that, we get our benchmark. And so we look for a 61% retracement. And if you notice, the 61% retracement takes you to 1080. And you also notice at the same time that that's pretty much where the market fell to. And the interesting thing about this technique is, especially in 2008 and 2009, it was tracking beautifully if you added a couple other things. And that was, first of all, you looked at different Fibonacci retracement levels, as we just have, and you also looked for particular candlestick patterns at these tops and bottoms. In other words, as the market was going down, we were looking for a pattern, and that pattern would be what's called a key reversal pattern, and a piercing line is one of them here. You get a shooting star at the top. This is that doji and inverted Hammond, the unique three-river bottom. Very, very strong pattern, and in fact, it was a great, great trade that we were able to do for those who were with me back then in a engulfing bearish up here. On neck pattern is simply an incomplete piercing line. My point is that I realized that it wasn't the indicators themselves alone that allowed a technician to really have great insight, but rather it was the indicators that they used and how they used them in combination together. That was great. Realized that I was personally familiar with John Bollinger and came up with Bollinger Bands. Later, when I began to lecture, I was introduced to Larry Williams. I was on a financial seminar for Dow Jones, which of course at that time was part of the Wall Street Journal, and it was a 2-month seminar circuit in which we basically went around the world. So I was able to really spend some time with very, very astute technicians, and Larry Williams was one of them. And I realized that I didn't really want to try to invent something new. I didn't want to reinvent the wheel. What I wanted to do was figure out which wheels were the best wheels to have on certain types of vehicles and how to utilize what's already there to make it work. Now, to give you an idea of how that actually not only transpired, but actually began to put profits in the coffers of my subscribers, because again, that's who I'm working for. We began to take these techniques and use them in real-time trading. I started writing for a website called Kitco Metals, and for those of you that are gold traders, you're probably very familiar with it. They are probably the #1 site for gold information in the world, globally. Again, I believe it's 1 million unique visitors a month. It's tremendous, and I started writing for them. I was very, very honored when they asked me to do that, because you have to be referred by 4 people. Two have to be in-house writers, and then the other 2 have to be people that you know that are already writing for them. Now, as you can see, this article was written October 4th, 2010, and the market already moved. We talked about this particular C here, but what I was looking at when I looked at this particular marketplace and realized that when the market was trading at 12 or 1300, it had just come off of this $1150 and $1,000 rise. You can see this $1,100 rise. That's right here. This is 11, and it had hit this high of about 1250, but it came back down to about 1050. This is where I mentioned George Soros was coming in. So we had wave 1. We talked about wave 2 actually being a 61% retracement. This turned out to be a 131, and this turned out to be a 38. This wave 5 actually was the same length as our wave 1. It came out to be textbook. We had our ABC, and so once I had our ABC in place, my sentiment was we're back into the impulse phase, and in the impulse phase, once we had wave 1 intact and we had our correction, I looked at the possibility of where wave 3 could go. Well, wave 3 at 100%, because realize it can't be the smallest of any of the impulse waves would take us to 1300, and 161% would take us to 1400. That was my assumption. The market was trading, as you can see here, at about 1230. And my basic belief was that this next set of rallies would take us somewhere between 1350 and 1400. And as I said, this was just based upon Fibonacci retracement, candlesticks, and Elliott wave. And this is how I came up with, derived these particular numbers. If I go to my next article, this article was the 11th. We're already at 1350. As you can see, I believe that my current count was here. We're in wave 2, market's moving up, and we're already at my first benchmark that I thought the market might go to. And what I felt was at that point that if what we're looking at is as follows: we had our wave 1, we had our correction, and now we were in wave 3. I felt that it would terminate, if you recall from the first article, somewhere around 1350 to 1400. This was what I believed. Now, I believe that if it did get that high, the type of correction that we would see, this is 23%, this is 38%, we'd get some sort of correction down and then go into our fifth wave. And as you can see, this is done on the 11th of October. And so if I go to my next article, which is the 18th, sure enough, we're up at around, what, here, 1380. And so at 1380, I want to start looking to see if there's any signs that we're getting top heavy. Realize my target was between 1350 and 1380. And what I noticed was a couple of things. First of all, and this again is that combination, I noticed on a straight Andrews pitchfork, and there are other techniques I use besides the three of them, but I found these to be pretty good. We're right at the top of that Andrews pitchfork. And so that was one indicator that told me, you know what, we might be getting top heavy. And another indicator was this candlestick pattern up here. And this pattern right here is simply called an engulfing bearish. Now, an engulfing bearish is simply a 2-day pattern, and there's some criteria behind it. The first thing is it can only occur after a defined uptrend. Well, we got that. You get a small red-bodied candle. That means that it opens and closes higher. And then you get the market opening at or above, because in a Forex market, it's continuous contract. It will always open at it. Can't open above because it's just the change in time. And then, but it has to close below. So we got this 2-day pattern here. We were at the top of the Andrews pitchfork. And let me scroll down a little bit. And then we got what's called a confirming candle. That's right here. So at that point, we're at just above 1380. We have the top of the Andrews pitchfork, we have the engulfing bearish, and we now have our confirming candle. And so when you go back to look at what I was looking at, I had a strong indication that we could in fact be coming to some sort of a top. Now, was I looking for the market to no longer be a bull market? Well, absolutely not. I was simply looking for the marketplace to run through a natural cycle. And as you can see, the market went from about 1380 and dropped back down to about 1320. And then we got this particular candlestick right in here. And this candlestick can either be identified as a doji because of that small body. A doji is simply where the open and close are very, very close or equal. But it was that size of the tail that gives it, basically, it's part of the umbrella group of candles. And the umbrella group of candles are simply known as a hammer on the bottom. On the top, it would be a hangman. And that's what I talk about here, is that this particular candlestick type, the hammer, and color doesn't matter in terms of the body, or the inverted hammer, are things that I look for. And I noticed that we got that particular formation down here, and at the same time, when we did our basic fib analysis, from the move that we saw at 3 to the amount of the correction, lo and behold, it came to a logical fib point. I think it was 38%, but I would have to check. So we had Fibonacci, candlestick pattern, Elliott wave, all kind of pointing to the same thing. And those were the factors that told me this this is something we want to look at. Now, we're not always right, because I believe in this particular case, the market continued to fall a little bit further. Well, actually, no, that it did point it out. It traded sideways for a while before moving up. And so, as you can see, one of the things that we're able to do when we combine all of these techniques together are going to be this type of strategy. Now, I noticed that a lot of people are asking, well, are we going to see anything current? And yeah, Soros is a buyer now. And this is my current take of the market right now. To directly answer those questions, let me get my tools to a different color here so that we can work with them. And this is what I'm looking at right now, and this is my current strategy and my current take or belief on the market. Obviously, we are in a different type of market than we were. When I started thegoldforecast.com, I almost could have been a chimpanzee to get it right. And what I mean by that is we were in a defined marketplace that was in just a beautiful upward channel, and then the market went parabolic. As you can see, this is our contract high of about 1920. Now, where are we at right now? We have been in what I call a long corrective winter. If you take a look, even our longer, more traditional corrections, in terms of a time parameter are anywhere just about a year, but that's the longest you'll ever see. This is a tremendously long correction. This, in terms of the time, was even longer. And I have to admit, we have made money here, but we've made money by me being incorrect. And here's what I mean. I looked at our original count like this. Let's go ahead and start this over. Originally, the market hits the top, and so what I'm looking for is, in essence, we had our long count 1, 2, 3, 4, 5. So we had our 5 count, our long count here. Now I'm looking for some sort of an ABC correction. The market comes down, we get our A, our B, and then when we got our first C, I said, you know what? There's no way the correction could have only taken this time, but we've got our double bottom, because at this point we've hit this bottom twice. And so we did go long here, but I went long thinking that we were now starting to enter the impulse phase. One of the issues that I have with my own strategies is that fundamentally I'm extremely bullish on the gold market. There's reasons out there, I think, that propelled the market from 800 to 1900. I think that those are still in effect. So I thought that that could be the conclusion. And we made a terrific trade because we caught $125 on the trade, but something strange happened, and that is that if we were truly in an impulse phase, at this point, we would have had to get some sort of a new high. And you can see the way I'm labeling it. There's 2 different labels I have on my current market scenario, which is an ABCX, ABC, and we're now in our impulse phase. That's one count that I have. But as you can see, when the market was unable to take out, and this is $1,800, and began to trade back down, there was no possibility, no way our count could incorporate any kind of an impulse phase, because it would not have gone this low, nor it would have been able to take out this upper top at 1,800. One of the more challenging parts or strategies was that as we watched this market trade sideways, right after that, and this is this area right in here, what I realized is we basically had a compression triangle. And I was uncertain of the count, but I was certain of one thing. Whenever you get a marketplace that has a compressed trading range, in other words, it can be characterized by a series of lower highs and higher lows. As it compresses, the belief is that as it hits the apex, the energy is released and it will go to the most prevalent direction of the trend. And so I assumed that was up, because the prevalent direction of this trend for the longest period of time had been up. And so we caught another good trade here, and I thought, okay, now we're in our impulse phase. And lo and behold, we hit this triple top. And when the market couldn't take that out, we entered this last really serious, this channel down. You can see what a strong channel down it is, and that's been the predominant characteristics of the marketplace itself for the last couple of months. we are long in the market. I believe we entered the market on this particular trade 1580. We got long in this area, and there was candlesticks, there was Fibonacci, there was Elliott wave, although Elliott wave was a much harder count in here that was signaling a potential bottom. Now, the best way really to characterize this market at this point is what we have is, as Elliott wave would call it, is a descending top and a flat bottom. And one of the strategies in Elliott wave, as I said, typically you get this 1, 2, 3, 4, 5, and then you get an A, B, C. That's textbook. In reality, there are about 8 different major categories of the type of correction you can have. And the one that this thing fit into the best was simply called a compression triangle. And a compression triangle is composed of 5 legs. And that would be something like 1, 2, 3, 4, and 5. After the 5th leg, you get what's called the thrust. And the thrust is what breaks you above this particular resistance line that's drawn from these tops here. If in fact it unfolds in that way, well, first of all, where we're going to know is where these 2 lines intersect, right in here. If in fact the market is able to move back up to this area, and we have a couple of resistance points before we get there, but if it's able to move this area and not take it out, that tells us one thing. And if it's able to cross and take that out, that would be when we get concrete confirmation, technical confirmation that we're out of what I call the muck. And the muck is this sideways trading activity that's been characteristic in the gold market. So as I conclude, I realize I've covered a lot of things superficially, but where I'm looking for this market right now to go to is as follows. I believe, let's go ahead and blow this up a little bit. Okay, so what I'm looking at right now is as follows. My belief is that it's quite obvious. We have ridiculous support between 1560, it started at around 1520, 1560, this is 1520 here, to about 1560, this is 50, so I'll just go across. And I realize it's not completely straight, so pardon me. But you can see that each time it hit these areas, we found really good support. On a weekly chart, of course, this week is only halfway through, but for the first time we got this market moving back up, and we had a very, very strong candlestick pattern form within our weekly chart here. Again, you see this really, really strong doji candle, this double bottom here. And the way I like to look at a doji is as follows. If a train is going from Los Angeles to San Diego and then back to Los Angeles, as it arrives at San Diego, before it goes back to Los Angeles, it has to stop and reverse. Dojis and the umbrella group of candles are the best visual indicator of a market consolidating. Now, a market can consolidate and it can indicate a top, as it does here. You see all these dojis here, but it can also indicate a consolidating area when it's trading sideways or moving up and resting, as you see here. In other words, the market had been moving up, doji sideways, it's just kind of collecting something. You did get a small downtrend, but then moves back up again. I am personally looking for the market. The first thing we've got to see is, if you notice this particular breakout point right here, we have to see the market be able to take out on a closing basis 1620 to 1625. That's where we saw this last breakout here, and that's where these tops are kind of lining up. If we follow this over, you'll see it's just shy of that area. We have to see how the market reacts in this area, first of all. If it can break through here, and I believe that it will, 1680 is our next point, and then 1700, of course, is that psychological level. The key is this: if we are truly still within a bull market, if the bull market isn't over, and I don't believe that it is, we will have to, one, break above 1625. We'll also have to go back and test 17, and we'll also have to go back and test 18, because 1800 right now, it used to be 1900, but that was a blip on a screen. You see, I believe the market went up too quickly, too fast, and the weight of a free trading market, an open market, is going to naturally take the market back to where it wants to go. In this case, we've been range bound between 1800 and on the low side, call it recently around 1560. Again, my belief is that we need to see how it reacts here, but if it can break through 1625, I believe there's really clear sailing till 1680. We're going to get something else at 1700. And the key is, and the most important thing is, when we look at this series of descending highs here, and really this kind of a flat bottom here, it's going to be the point in which it intersects with that resistance area. If and when that happens, we can say with real conviction that the bull market is back in play. Thank you so very, very much for your time, and I will open up for questions unless there's something Andrew needs to say. All right, I've got a couple of questions coming in. I'll try to, it's based on comment. All right. Are we going to see anything on the current chart to understand the current situation? I hope I answered that. So do you see 1527 anytime soon prior to 1800? Actually not. If we are in a true back in the impulse phase, and understand I got it wrong here. So this market, until we really, I hate to say, but it's going to be after the fact, until we get the market breaking above this intersection, I won't have real strong technical confirmation. But to answer your question, do I think that we will see 1527 before 1800? I would have to say no, but also realize that I am a staunch bull in the market because of the fundamentals in play, so I do have a bias. Dave, do you see the US dollar rally to higher levels beyond 83.50 causing gold to move lower or stay in consolidation? Well, there's no doubt that's a really valid point. Realize that when we pair gold against the dollar, if the dollar gets strong, you have to, it's almost like salmon swimming upstream. You've got to compensate for that before you have any kind of a rise. So that has been putting a damper on the price of gold. But if we look historically, there are times when you get a strong dollar and strong gold, because typically when you get safe haven buying, the move is to dollars and the move is to gold at the same time. See the next question. If you look at GDX weekly at 60%, okay. How likely is it that the downtrend to 1500 would occur despite your more likely upswing? Nothing's etched in stone. The market itself, listen, the market itself has been in this defined down channel from about 1800 back from September of last year all the way to about February of this year. That's the first thing. So it could do anything it wants, but let me just go ahead and shrink this up, because the other thing that you'll notice is I have done studies, and typically if you look at the beginning of the year, we typically get the absolute high or low of the year back in February. In each year we can go through it, but February has been a time in which we have had bottoms in the marketplace itself. This, I believe, I would have to go through, but February has been that kind of a month for gold. A downtrend. If the market does finally break to a new top, say 2000, what is your take on the following correction? If we are in fact in a bull cycle still, in other words, the question, because of this really extended correction here, my question is, are we looking at a major fifth rather than a major third because of the length of this? The key is this: if the fundamentals that have been driving this market are still in play, I believe the bull market's going to be in play first. Secondly, gold really doesn't change in price at all anyways. It's simply the relationship between gold and the currency that it's paired with. And the story that I used on my last chart, this was that in the 1800s, if you had an ounce of gold or a $20 gold piece, go into any town, get a fine steak dinner, get your haircut, shave in a haircut, buy a suit, and stay at a nice hotel. Today, if you had an ounce of gold worth roughly $1,600, you could do exactly that. So gold really hasn't changed. We've put this intrinsic value on it globally, but the bottom line is it's the reflection of currencies getting weaker, not gold getting stronger. As long as that's in play, gold has nowhere to go but up long term. Does break. If the US dollar goes up, you need the VIX for gold to go up. Yes, that's correct. Do you use intraday charts for Elliott Wave 30 and 1 hour? Yes, I do. I typically am a trend trader. My belief is that after having 30 years in the industry, what I found were that my idols, the people that I saw consistently make money in the market, Soros is one of them, Dennis Gartman is one of them. These guys were trend traders and they tried to capture long market moves, and that's where they made their money. To give you an example, last year we did 250% profit overall, but if you look at all of the trades that I did, and I believe there was under 20, maybe 18 trades over the year, there were 3 of them that produced 70% of the profits, and the other ones were either up 20 or down 20, kind of canceled each other out. The big money came when I caught the big trades, and those big trades that I'm talking about were, for example, catching this trade here, or we caught this one here. But the big money comes when you catch these long trades. If there is an impulse wave to take out 1800, what could the price go to? Well, my target is between 2100 and 2200, but I've been reassessing it because the market has truly not gone back into an impulse phase. But in essence, what you do in a scenario like this, again, these are micro and macrocosms, we would look at once wave 1 is intact, we use that as our benchmark, and that's when we can do our analysis for our upside target. The fact is I made the analysis down here based on the fact that we were in our impulse phase and we were not, and that one was between 2000 and 2100. In terms of my intraday charts, you will find that they are just as effective as the longer term charts in terms of giving you clear, concise information of pivots and reversals. When do you think we will see? Yeah, Lewis, I wish I knew. I thought we would see it much sooner than we have, but the key is this. Before we get to 2000, the question is, will gold break above 17? And more importantly, will it break above this triple top? Because that's the key. Once we break above this, I can give you a better model. Right now, any models that I give you are making an assumption that we're back in an impulse phase, and I'm making an assumption not based on technical evidence, because I said I can't give you that technical evidence until we cross really above at least this channel here. They're coming in fast. If there is an impulse wave to take, okay, I gave that one. How much influence has manipulation affected the price of gold? You know what? That's a really interesting question. It's better put with silver because it's a thinner market. My belief is ultimately markets can be jiggled, but they cannot be outright manipulated. And here's what I mean. When Soros went head-to-head with the Bank of Japan, they were trying to have their currency do a certain thing. But that currency did what it naturally was supposed to do. All bank intervention can do, or I should say Fed intervention for the dollar can do, is make the fall or the rise happen in a more orderly manner, but the dollar is going to go to where it naturally needs to go. So in terms of manipulation, we could spend an hour on that because it's a huge topic. Because of the time involved, we'll have to leave that for another webinar. I'm going to take a couple more because I know that everybody's time is precious and we're getting on that time. What about the gold miners, GDX? Well, here's the thing with that. I'm often asked, what about these gold stocks? Gold stocks run independently from the price of gold because you have the cost of doing business, the mine's production costs, all of those things, and how much profit, what they do with the profit. I find it almost impossible to have direct correlations between mining stocks and what I think the price of gold is going to do. Obviously, they've been underperforming, and they're underperforming. I don't know why. It's not something that I follow. Notice that we're diverging from gold price with the euro. Your thoughts as it relates to Cyprus and other bank problems? Well, the key is this. Quantitative easing obviously has affected gold very, very strongly. And the European Union's, their crisis has influenced gold because you get safe haven buying with the euro crisis. You know, they say that the scenario is resolved in Cyprus, but again, they're riding in the streets of Greece. So I think the chapter has not been written in terms of what's going to happen. I think that it could have an extremely bullish effect on gold. Is it a store? Okay, it is a store of value, but not yet a payment method, but preserves a buying power, as you said. Okay. Could you comment on the MACD lines on the bottom? Absolutely. I do use multiple techniques, as I've really tried to talk about. And these multiple techniques that I use are ones that give me great insight into the market. And what I found is that, especially with the MACD, you'll notice that you can, in terms of where your count is itself, you tend to get, for example, this is 1 to 2 here, and then if we go straight down, you'll notice your cross comes a little bit after. 1 here, here's our cross. What it does is it confirms when I'm looking at a particular count in the for the Elliott wave count, what I'm looking to see with the MACD is there some sort of a correlation between the top of the MACD? Are they crossing at that point? And as you can see, by combining the two of them together, you get some pretty good insight into the marketplace itself. So many times I have the MACD on the bottom. Do you use Fibonacci's did I use Fibonacci to arrive at the 2100? No, in essence, what I did is I used the modeling technique. And the modeling technique, I said that if wave 1 starts here, I had no benchmark for wave 1, so I basically looked at the last wave 1 to fix it, and then 61% retracement, 1.31% higher, 38% retracement, and 1 times wave 1% higher. That's how I arrived at the 2100. Can you show the wave count in today's 30-minute chart? We just don't have time for that. I'm sorry. This is the only method to figure out the extent of a given move up or down. Is this the only method? Well, you know, it's the only method that I use because I found it to be effective. The most important method is really your eye. I mean, your mind is the greatest computer in the world. So if a market's falling, there's no fib that's telling me if I look at these series of bottoms here and the market's dropping, to look for a bottom right here is not using, I'm using basic trend analysis, and I'm using basic price discovery. I think that one of the best indicators of tops or bottoms are prior tops or prior bottoms. I hope that answers your question. If rates go higher, will that kill the gold market? Well, first of all, it's not if interest rates will go higher, it's when interest rates will go higher. And the effect is going to be a push-pull because, of course, the idea behind this quantitative easing and this cheap money is to stimulate the economy. It's not going to last forever. And as they ramp that down, it will have an effect. But you're also going to get another effect, and that is as interest rates go up, inflationary pressures are applied to that. But absolutely, that I believe will have an effect on the market. Please organize. Thank you very much. Can I explain a bit on the subscription service? Do we get any buy-sell recommendation? Okay, a shameless plug for my service. I'll do one. The daily report that I offer has a basic video that you view once a day that I produce. Typically, by this time, it goes live. Any buy or sell recommendations go out by special trade alert. Those are sent by special emails with stop placements. When I make recommendations, some of my traders are physical purchasers, some are traders, some are investors, and I try to address all that. But I have a very, very defined service that I've kind of worked with over the last 3 years. It's the best that I can offer, and it gives you a lot of information, as much as I can give you. Thank you, Gary. I agree and see the central banks buying gold, with euro playing less of a role. Well, you know what? The central banks have been buying, and to me, that's telling you something. Um, Brad, manipulation is government China, Russia bought more than 1 month. There's no doubt. I don't even have time to begin to express the influence that different countries have on these different prices. Western banks could be selling gold with physical gold's influence. Yeah, I think that's about it in terms of questions you guys might have had. I hope I covered enough of current, and I really wanted to set up the current as to how I came to those conclusions, how I developed these techniques before just telling you this is what I think, because now at least you have a little bit of insight into how I make my good and bad calls. I want to thank everybody for spending some time with me. I'm sure this will be the first of many webinars that I do with the people over at eSignal. They're a great firm, and honestly, I started using their data in 1990. They've got the best data in town. Thank you so very, very much for your time. Bye-bye.